Welcome to All Things Financial Podcast. Trey Peterson and Yelisey Coots. We're talking about questions that you shouldn't ask your financial advisor. Join us for a great podcast on what not to ask. Welcome to All Things Financial. Trey Peterson and
Yelisey Coots.
And today we are talking about what questions not to ask your financial advisor. One of the things that our goal is on this podcast is to help you retire once so you can retire well. The other thing that I would say is if you're young and you're preparing for retirement, you're also going to get a lot out of our conversation today. So let's jump in. We get all kinds of questions over the last 8 years since we opened up our office, 12 years of being in financial services. We've heard all of it, the good things, the bad things, the interesting things. And today we're going to talk about some of the things that you shouldn't ask. So one of the big questions that I get a lot is if I come work with you, can you guarantee a certain rate of return? Yelisey, what would your response to that be?
So technically you're supposed to say no, but I think it all really just depends on the different types of tools you have in your toolbox, right? If we're just talking about securities and risk management, even though there are investments, even in that area that have guaranteed rates of return, there's different types of risks associated with those returns. So like if just on its surface,
market risk, regulatory risk,
interest rate risk, there's all kinds of things. But if you're simply asking me just, can you guarantee that you're going to make more money? Yeah, you can, right? There are things you can do to guarantee that that person will have more money, like a treasury bond, like a money market fund, right? I mean, even those funds can technically go bankrupt, right? But they're very unlikely to.
Well, what I tell people is if someone tells you it's guaranteed, run for the hills because there's not a lot that's guaranteed. Now, there's things that are likely, right? So we can say this portfolio has averaged 12% or 15% a year the last 5 years. Past performance doesn't guarantee future performance. Right. So you don't want to guarantee it. But what you can ask is, hey, what kind of returns can I expect or what have you seen in the past?
Exactly. Do your due diligence, right? You want to see how that portfolio has performed over the last however many years you want to look at. Yeah. But yeah, outside of that, no guarantees.
One of the biggest questions I get is, Trey, you talk about it, all things financial. You help people with investments, taxes, and insurance. Can you help me make sure that I don't pay any taxes on my withdrawals in retirement? What's the response to that?
Yeah, but we'd have to lower your income to a very uncomfortable level. And then we can pay nothing in taxes.
So at All Things Financial, we help people pay the least amount of legal taxes.
Yeah.
But you still have to pay your taxes.
Exactly. We all believe in, making sure that you don't leave a tip on the table, but you have to pay your taxes. And, and when you think about it, there's a lot of things that we enjoy, like the roads that we get to drive on the way to the office. There's all kinds of public good and utility that we have from the taxes. Now, some people might say, hey, the taxes are being mismanaged. They're not being managed in the way that I would spend
Yes,
those
they
dollars. And maybe there's an argument there. But,
run for governor.
We all believe in paying our taxes, our fair share, but not a penny more.
I would say one of the things that we often say, though, is if you are preparing for retirement and one of your goals is to minimize your taxes, one of the things that you can do is work with what we call a home office. What's a home office? It's where you have financial services, investments, insurance, and tax all under one roof. And one of the things that is unique about All Things Financial is that we help people with all of those things. We've got enrolled agents, we've got CPAs, so that as you take money from your investments, you know where to pull money from in what order, which typically we would talk about pull from your non-qualified assets, meaning non-retirement assets, your pre-tax assets, and then your Roth last. But your situation can change some of those things. So one of the things that we can do is help you pay the least amount of taxes, but we can't help you pay no taxes.
Yeah. And then just to piggyback on that a little bit. So, if someone's looking for some advice, and this is, I would say, true for just about anybody, a lot of times asset location is part of that advice, making sure that you don't have interest and dividend producing investments in an after-tax account. Because those dividends and interest, they're going to be introducing taxable income to you. And a lot of times, people, they can tell you how much they have from work. They can tell you about their pension, or they can tell you about some fixed or guaranteed sources of income, but they won't be able to predict their interest or dividends accurately. And sometimes that's what pushes them into a higher bracket.
Well, I would say if somebody is in and nearing retirement, which is who we ideally work with, up until now, the last 30, 40 years, the name of the game has been save as much as you can, and hopefully the market has performed. As you prepare for retirement, the next thing that we would say is you need a spend down plan.
Right.
Where do you pull money from, in what order? So can you pay no taxes? No, but we can help you pay the least amount based upon your expenses, your assets, and your goals.
And I would say the next 4 years is a very unique opportunity. As most of you know, the Tax Cuts and Jobs Act, the tax brackets and the rates, they've been maintained, right? Indefinitely, unless Congress were to pass a new law and then change things. But, as far as we're concerned, it's permanent. Yeah. And one of the nice things too, especially over the next 4 years, we have a temporary senior tax deduction. That's $6,000 per person. So if you're married, you can tack on an additional $12,000 as a temporary standard deduction on top of the already $31,500 standard deduction in 2025. So for some people, hey, you don't know what the future holds. You have RMDs coming up potentially in a couple of years, but you have these 4 years where that might be an opportunity to maybe do some Roth conversion, some other tax planning and things like that, where you have more room in the tax brackets.
Question number 3 that I get often is, Trey, can you tell me what the market's going to do this next year? I love when people ask that because we have no idea. We can make an educated guess based upon listening to the economists that we're listening to, based upon looking to see what's happening in politics. But the thing that I would tell people is we need to have a plan and a strategy based on if we have a bull market or a bear market.
Yeah.
And so one of the things that we talk about is different buckets of money. If you've never had the conversation with your advisor on having different buckets of money, one of the things I'd encourage you to do is get a second opinion from one of our advisors, whether it's you or me or Ryan. And one of the things that we can show you is in retirement, if the market continues to take off like it has, here's where you would pull from in that situation. If we have a correction or we have a collapse, here's where you pull from in that situation. So we can't tell you what the market's going to do, but we can create a plan where you win in all situations.
Right. It's very unpredictable. You can't. I mean, it's your guess is as good as anybody else's. But like you said, you have to have a plan for all those different scenarios. And I think it's an important thing too, because when we talk about like having a correction in the early part of somebody's retirement versus the latter part of their retirement, I mean, chances are, depending on how long you're alive, you might experience several corrections throughout retirement. But it really does make a difference, and we refer to it as sequence of returns or sequence risk.
Right.
Which
most people have never had that conversation.
They've never had that conversation. And you need to be able to have a plan for both of those scenarios, whether or not you experience a correction on the front end. I know the headlines in the Star Tribune here in Minnesota in 2008 were 3 out of 5 seniors ended up having to go back to work or stay in the workforce longer. Oh. And really, it's a matter of timing. I mean, it's we're not timing the market, but you're timing on retirement, and depending on what's happening in the market, that could cause you to have to course correct.
Mm-hmm. Question number 4, give us one. What's one that you hear often that you don't like?
I don't hear this one often, but I'm always caught off guard when people ask, "Can you help me hide money?"
Yeah.
And it's not
sometimes from their spouse.
Right. Sometimes it's from their spouse. I assume they're typically referring to the IRS, and then I'm always caught off guard when they're referring to their spouse. But I don't know. Everyone's situation is different. Like we meet folks that maybe their spouse actually does have a spending problem, and we're like, yeah, like I would hide money from that person too. Like we've had people that spouses that are found out that they're this person in particular, that her husband had a gambling problem.
Yeah.
And left her with all kinds of debt after having passed away.
Right.
So there are situations. I don't know what the rule of thumb here is. It probably it varies on a case by case basis. But never hide money from the IRS, from your spouse. It depends.
Yeah. One question that I get a lot that I think people ask it to feel better, but they ask, "What are your other clients doing?" And so I don't mind talking about averages and what others do, but one of the things that most people don't realize is that your ability to take risk, your expenses, and things like what's the age difference between you and your spouse can completely change the recommendation that we have for you and your wife or you and your husband compared to another couple that have the same amount of assets. And so one of the things I would say to people is don't do what everybody else is doing just because they're the same age and have the same amount of assets. You have to look at all of the facts to say what's best for us. And so one of the things I think we do really well at All Things Financial is we don't predetermine the investments that we're going to use based on knowing somebody's walking in the door. We do a great job of saying, hey, what are your expenses? What are your assets? What are your goals? And then being in a fiduciary model where everything is fee-based, We say, now, based on the menu of all of the options that are available to you, here's what our recommendation is. Let's build it together. And so I would just say, well, it might be helpful to know what the average person with your assets, how they're investing. It doesn't mean that that's what your recommendation or our recommendation would be.
Yeah, and one big difference that I keep noticing is, we can line up 4 or 5 clients and they all spend the same. They all maybe have a different similar amount of assets and places to draw from, fixed income sources, all of that. But one thing that could be different between them is their fixed expenses. Some people, a larger percentage of their expenses is lifestyle. Mm-hmm. And those people actually have the ability to adapt if things are, if things go south and the market dips, they can go on fewer vacations. They can spend less money on some things that are non-essential. Other people, meanwhile, like they have a giant mortgage in retirement. They're accustomed to buying new vehicles, and their fixed expenses are quite high, and their leisure actually isn't necessarily like a huge portion of their budget. Yeah. So I think that even like people who have similar expenses and similar assets, like that makeup, I mean, there's so many different things that could be different between you and another couple that on the surface, it looks like there's a lot of similarities that really make the advice different.
I would say too, under questions that you shouldn't ask your advisor, when people say, what are your other clients doing? The thing that they don't think about is that people have different risk tolerances.
Exactly.
So I think about, one of the couples that we work with, they have worked really hard. They remember what it felt like to lose in 2008, and they never want to feel that again. Yeah. And so they are invested in a conservative portfolio that would be about 50% stock and equities and 50% safety, whether that's bonds or money market T-bills, annuities. They're 50-50. They referred some friends to us that also have done a great job saving, and that couple is very comfortable with risk. They have taken risks their whole life. They have owned businesses. They've started things. They've sold things. So they're very aggressive. So even though these couples are the same age, one couple is 90% stock, 10% bonds, while the other is 50-50. So what I think about is we can't say, here's what you should do based on your assets and expenses. There's more. What does your risk tolerance look like? What kind of returns do you want to see? And how comfortable are you when the market is down?
Yeah, and you couldn't have picked 2 couples that are further apart on the risk spectrum.
I've even told them, because they're great friends, when you guys are together.
Exactly.
And you're talking about what Yelisey and I have built for you, you just need to know that while you're at the same place, the solution isn't the same.
Yeah. And I feel like,
because they do talk.
We've had this conversation with them a few times, and there's always that element of managing expectations because, so far the market's been doing really, really well. So if they're comparing themselves to their friends who have way more risk,
right?
Like the conversations are going to be a little bit,
until the market dips.
Get on the grumbles a little bit. And then when the market dips, you realize, hey, this is why we actually didn't have as much risk. So yeah, everyone's a little different. I get this from time to time. People ask me what I'm investing in.
Yeah.
Which, like, my risk, probably even compared to somebody who's my age, is quite a bit higher.
So, I mean, let's talk about it. So at All Things Financial, one of the ways that we manage money, kind of the main way, is through mutual funds and exchange traded funds, ETFs, right? Yeah. And so if you're new to us, Yelisey's role with our investment team is to pick and manage the funds. What is unique is that we don't invest the old school way, which is you pick 10, 15, 20 stocks, and then we rebalance based on how things are going. We rebalance, but instead of being spread across 15 to 20 of the largest companies, the Magnificent Seven plus a few others, our average client is spread across 13,000 different companies. And while they're not going to have the big swings of 30% returns and 40% losses, what they are going to have is what most people preparing for retirement want, or people that are retired want, which is stability and good returns over time. I get this question every once in a while, can I retire by this, and can you guarantee that everything's going to be fine? What's our response to, can you guarantee that I can retire in 12 months?
I would have an easier time guaranteeing we'll make you money than guaranteeing something like that.
Yeah.
I mean, there's just so many different variables. And we know this from just on the software side, because we're doing data entry all the time, and we see millions of different scenarios. I mean, change one thing, change expenses by 10%, change inflation by a little bit. What about your rate of return? Or if there's like an emergency, if there's a financial emergency or a healthcare related emergency, or maybe, the other day somebody called in and her spouse was having a bad day at work. Well, her spouse is like in his late 50s. He shouldn't be retiring. If you take away the income that we're projecting to have for the next 10 years and you just say, we're going to stop today, that changes the outcome entirely.
Right.
Now, they might have enough money for, to live up until her life expectancy, but what about his, right? He's a little bit younger than her. So, I mean, there's just way too many variables and way too many unpredictable things, let alone returns, expenses, inflation, the typical things that we often contend with.
Yeah. So one of the things that we tell people is we can put together a retirement plan that we are comfortable saying that you are going to stay on track if we stick to this.
Yeah.
The other thing I think that we do really well is that we use conservative inputs when we look at projections to get the output. So one of the things I show people often is when we show returns moving forward, we're showing returns of 6% a year in most examples while you're working and 4% in retirement. Well, thankfully, we don't have any clients that over the last years are only averaging 4%, or they probably would have fired us. But what that does is every 2 or 3 years, your projections look better. Instead of what we see a lot is people come from an advisor that told them they were going to be in this amazing position, and every couple of years things look worse because they were projecting returns of 8 and 10% with no down years. So one of the things that we're committed to, because we know that if you come to see Yelisey and I and you're preparing for retirement, even though we're going to talk about investments and taxes and Social Security and Medicare, at the end of the day, what people are looking for is, does this add up to financial peace?
Yeah.
And I think what I would tell people is we do a great job of putting together a conservative plan so that we can be confident that when you say, I want to retire, that you and I can look at the situation and say, based on these conservative returns, based on what we've plugged in for inflation, things are likely not just to be as good as we think, but they're likely to get better. I would say too, one of the things of a great financial advisor, I don't know that anybody asks this, but I like to talk through it, is, are you going to let me know if I get off track? So one of the things I think we see a lot is a lot of financial advisors are not great planners, but they're great salespeople. And I think one of the downsides of that is that they're extremely optimistic in their planning. One of the things I love about my role is if people get off, if they start overspending, or they've had 6 months or a year or 2 years, or they're spending an extra $1,000 or $1,500 or $2,000 a month, we don't just pretend like everything's going to be fine. In fact, one of my hardest jobs as a financial advisor is sitting down with a couple and saying, hey guys, I'm concerned about you. You're overspending. Here's the plan that we put together. You might have a year that your expenses are higher than we thought, but now you've had 2 years of that in areas that you have control over. One of the things I want to talk with you about is, are you open to changing your expenses, or do we have to talk about working longer? So one of the things that we talk about is there's different levers. Do we work longer and bring in more income, contribute more to the retirement account, or do we lower expenses, retire early? And so there's different levers to pull. But the thing I would say is you need to have an advisor that's a conservative planner, that once they say you're going to be able to retire, you can stay retired, but they're also going to have the hard conversation of, hey, things are not on track. We need to reel them back in.
Do the fees justify hiring a financial advisor?
Yeah.
And I think that that one aspect alone is a good reason to have one.
Right.
Is a good reason to pay those fees. If you can have someone who can actually have some of those hard conversations with you, letting you know that you need to cut back, I think that that's probably worth the fee itself, because a lot of times if you're left to your own devices, I know that, just as a human nature kind of a thing, not like our clients specifically, most people aren't going to make the right decisions when it comes to cutting back on some of the stuff that they truly enjoy,
right,
if it means the difference between making it enough.
There's a great article, if you're listening, there's a great article that Vanguard did. And basically, I think it's titled, Is an Advisor Worth the Fee? And what they proved is that if you have good professional management, that you should net 1% to 2% above the fee. And so not only are they paying for themselves, but they're earning, their fee. Yeah. The thing that we do know is that when we talk about returns, we've had great portfolios that have done really well in the past, but there are things that we can't measure. Like, what is it worth when your advisor rebalances the portfolio and instead of being down 15%, you're down 7 or 8? Now you don't have to make up for a 7 or 8% additional loss. Taking Social Security at the right time so that you're creating more tax-free dollars in retirement. What is it worth to get that right the first time, instead of you're retiring, you've never helped anybody retire, You've got a financial advisor that's helped dozens and hundreds of people retire well. What is it worth to get that right? What is it worth knowing where to pull money from in what order? What is it worth to know what to sell and what to keep? So there are things that we can say, hey, based on the last 5 years, not only can we give you the same or greater returns, but we can save you from a costly mistake. And that's one of the things I tell people is, man, a lot of people know this, but I wrestled for one of the top high school programs in the country, Apple Valley in Minnesota. When I was in high school, we were ranked second in the country 3 out of 4 years. And I had a coach that said something to me that not only did it help me in wrestling, but it helped me in life. And he said, Trey, you don't have to be the best at everything, but you need to find somebody that is and take their advice. And so what I would say is not just in the area of financial planning, but when it comes to making big and quality decisions, have somebody that's helped others through what you're about to go through so that you can learn from mistakes they've seen other people make and so that you can take advantage of their experience.
If you were to give somebody advice, like somebody who's retiring, they're 65 years old, they just show up in the office for the first time, they're just getting to know you, and you could direct them or coach them on how to think about retirement. Like, what's one thing that you would shift and say, hey, if only people could think about retirement in these terms, how would the quality of their retirement increase, or how would it be better if only people thought about retirement in these specific terms?
Yeah, well, I think there's a lot of ways to answer that. The first thing that I would say is people that enter retirement on their own decision tend to do much better than people that enter it on someone else's decision.
So forced into retirement, layoffs, things like that.
So, but let's talk about that. So I think that perspective is a big piece of life. Like, we've all heard that 90% of life is responding to what happens to you, not what happens to you. And so one of the things I would say is, let's say that you were forced into retirement. You planned on retiring at 66. You love your work, but at 64 years old, the CEO of your company brings you in and lays you off. And now you go, well, no one else is going to value me the next 2 years. No one's going to pay me what I'm being paid. What I would say is, if you're getting laid off at 64, instead of working till 66, and you financially have the ability to be retired, you need to pre-decide that I'm going to enjoy 2 more years of retirement. Or you need to pre-decide, I'm not going to finish at the company that I wanted to finish at, but there must be something bigger. And if I can get into my faith, God must have something better for me, or he wouldn't allow this to happen. So what I would say is that perspective is everything. So if you get laid off, or if your job changes, I think that there's likely something better, or maybe you're supposed to experience and enjoy retirement sooner. Now, as far as the practical things, one of the things I think we do really well is, most people have never thought about this, but their paycheck has always come every week or every 2 weeks or maybe once a month. And then they take a part of that paycheck and they add to a 401k. And even though, the market is up and down, historically it's gone up basically every year, every couple of years. And so one of the mind shifts is, now all of a sudden your paycheck isn't going to come from work. You're no longer going to contribute to this retirement account that you've spent 4 years retiring to. Now your paycheck is going to come from those retirement dollars. And so one of the things I would encourage people is, that's what that money's there for. It's a different feeling, but it doesn't have to be a negative feeling. And remind yourself that the reason you've saved is so that you can retire and enjoy the end years of your life, that last 2-3 decades. Because in my opinion, your retiring years, your years in retirement, if you do it right, if you think about it right, if you hire the right financial team, they should be the best years of your life. I think it goes back to the way that you think oftentimes determines the quality of your life. So as you prepare for retirement, what I would tell people, because the average person spends more time planning their 2 weeks of vacation than they spend planning their whole life. And so what I would say to somebody preparing for retirement, and you and I have both seen this, is don't wait until you retire to decide how you're going to spend your retirement. Find a hobby, find somewhere to serve, find somewhere to give back. One of the things I love about what we do is we have a high percentage of clients that when they retire, they spend most of their time serving, whether it's in a nonprofit, a 501c3, at their church. And if they have grandkids, they spend it with their grandkids. And they joke about, how many bad basketball games they have to watch their 6-year-old grandson, not even dribble the ball right. Or, like how many baseball games they got to sit and watch all these kids strike out. But what I love is when grandparents talk about watching their grandkids and they're spending the best hours of their best days with family and serving others. I just think that those days can and should be your best if you plan for it. So instead of wandering in retirement, plan for retirement. Find your purpose. And I think that those days, those hours, as a lot of our clients say, is I don't know how I ever had time for a job because they're so busy, not just doing things, but doing the things that they care most about.
I think that to answer the question back to me, if I were to give somebody advice, I would say, if they're still working, they haven't been forced into retirement, I would say don't hang on too tightly to that job as a source of your identity and what you do, because nothing is guaranteed and you could be let go the next day. So I would say that as much as that maybe is part of your plan for this to be your final job, I would say have a contingency plan and look at it in a positive way. Like, what are some consulting opportunities that you have if tomorrow this employer just lets you go?
Yeah.
Well, not only consulting, are there any other companies where they would find value in the skills that you have and what you've developed in yourself over time, and have that just be part of the contingency plan, knowing that if worst case scenario happens, you still have a place to turn. And on top of that, if it doesn't work out, invest into grandparenting, volunteer work, anything like that. And just don't look at it as the end of something, but a beginning of a new chapter.
I would say that perspective, just to kind of wrap this up, perspective is everything. Decide that whatever happens was supposed to happen and that whatever's next is better. Because I think oftentimes in life, you kind of say this too, is even if it isn't true, if you decide what's next is better, it will be. If you enjoyed today, I would encourage you to check out podcast number 50. Yelisey and I did our first leadership podcast. So in addition to bringing you financial tips and retirement tips, we want to bring people into this room that have had a positive and big impact on my life, Yelisey's life, or both of our lives. Episode 50 was the first one where we interviewed President Mark Rutland, or Dr. Mark Rutland, from our university, Oral Roberts University. We've got more coming out on leadership. Check out episode 50. We look forward to seeing you on the next episode.
Advisory services are offered through CG Advisory Services, LLC, a registered investment advisor, and through Guardian Wealth Strategies, LLC, a registered investment advisor. CG Advisory Services, LLC, and Guardian Wealth Strategies, LLC, are separate and unaffiliated entities. The topics discussed on this podcast are for educational purposes only and are not intended to be investment advice or recommendations. Listeners should consult with their own financial professionals before making any investment decisions.